Good afternoon. Welcome back to Your Money Matters. I am Angela Giroux, and as you can see, I've got Clint Lee and Ted Bauman both with me today. I hope you've been enjoying our videos. If you have, I hope you're a subscriber to our YouTube channel. And if you're not, this is your opportunity. There's a link below. You can subscribe. It takes about 2 seconds. You'll be first in line every time we come out with a new video. And if you are ready for a deeper level of Ted's research, you want more specific stock recommendations, then the Bauman Letter is perfect for you. Click that link up there. You can see all the benefits of membership, and it's risk-free. Now, guys, I gotta say, I'm in a pretty good mood today. You know, we sometimes go into these videos and there's a lot of bad news out there, all summer, all fall. We've been talking about the directionless market, that the S&P is hitting all these new highs, but it's just a handful of mega caps really driving that rally. And most stocks had no idea we were in a bull market. But we were talking earlier, and it seems like things might be changing, especially in light of the job report that came out on Friday. I mean, it was just phenomenal. And it makes me think that maybe we're turning a corner. So Clint, I want to ask you if we're turning a corner, but before I do, I just wanted to tell the folks watching that you are going to get some actionable ideas at the end of this video. So make sure you watch all the way through. But Clint, back to you. Are we turning a corner? Say yes.
Yeah, I think today is definitely a good news day. We're a lot of the things that have been holding the economy back. We are starting to turn the corner. We're starting to see some good news. It's Friday as we're recording this. We had the payrolls report this morning. We know that we've had a couple consecutive months now of just really poor jobs figures coming in well below estimates, while we're bucking that trend, at least for this most recent month. Looking at the October report, is 531,000 jobs were created. That was better than expected. On the plus side as well, somebody must have counted wrong because they revised the last 2 months higher as well. I think the combined revisions for jobs created in August and September went up by another 235,000 jobs. So here's a chart of how the recovery in the jobs market looks. This looks at the loss in jobs, as the pandemic started, and how we've been able to recover since then. So really great news that we're starting to see this accelerate. This has been one big question mark in terms of getting people back into the labor force. We've talked about that one recently. So good news there. Some other good news is that with the spending that's out there. One big constraint is on the supply side. People, even though the demand's there might not necessarily be the supply to meet it. We're starting to see some initial signs that supply crunch is starting to ease. So here's a couple charts to highlight that point. This first one comes from Bloomberg. This is a supply constraint indicator. And basically how to interpret this is when this line is above zero, when it's positive, that means we're in a supply deficit, vice versa when it's negative. And you can see on the right-hand side of the chart that we're recently at the highest level in at least a decade in terms of supply deficits, but it looks like that's peaked and is now starting to turn lower. And another sign of that, we're starting to see freight rates come in. So here's a chart of the Baltic Dry Index. This just tracks how much it costs to ship raw materials overseas. And we had this quick peak, but this has been coming in pretty quickly. So just suggesting that, once again, we're starting to see some of the congestion in terms of being able to ship things is coming in. That's easing. So that's a good sign. COVID cases, let's talk about COVID cases really quick. Those are starting to come in. Recall a couple of weeks ago, we got the third quarter GDP report, which was actually pretty disappointing. But in third quarter, we had the Delta variant cases peaking out. So here's a chart of what that looks like. But since then, since sort of that August, September timeframe, we've seen a quick decline here in COVID cases. So we know that's been one big constraint on the economy recently as well. That's improving. So you put it all together, and what we're seeing is that services sector demand is just absolutely ripping higher. So we got a look this week at the ISM, their services activity gauge. And so here's a chart of that going back, I believe about 10 years or so. And what I want to highlight on here, the dotted line through the middle of this at that 50 level, when this index is below 50, that means the service sector is shrinking. When it's above 50, that means the service sector is expanding. And the higher, above or below that line you are, the more meaningful it is. And we are at the highest level ever for this index. So it came in at 66.7 this week. Once again, it's the highest level ever. And so just as we're turning this corner, it's really showing up in that service sector activity.
Now, Ted, you in your fancy polo shirt today, we know the markets are liking all this news today, but what are we seeing sort of, taking a deeper look at the market? How is it responding?
Well, as I've been saying to you guys earlier today, it's almost as though the predictions for economic recovery that people were making back in January are starting to come true. I mean, we basically got thrown off the rails by Delta. And now that that's fading away, we're getting back to the kinds of stock activity or sectoral activity that we saw earlier this year, which was all about cyclicals and industrials and all that sort of stuff. And so right on cue, that's the kind of rotation we're seeing. Here's a chart that shows gains to date in terms of the S&P 500 main sectors. The big one obviously is energy. That's because it was off such a low base. Financials also, real estate, another big winner. But if you look down the bottom, it's things like staples, industrials, materials, discretionary. They're the ones who haven't done quite so well. Discretionary has actually done reasonably well, but that's because the people were buying that. It's all this stuff that's stuck out there in the, in the ports. That's what that is. But now let's look at a chart of the last couple of days, and there's quite a reversal going on. Energy's down the bottom, financials at the bottom. Real estate's dropped a lot, but at the top, you've got consumer discretionary, information technology, materials, industrials, staples. So basically what that's telling us is that the market is coming back to the view that this is a recovery period we're in. So right on cue, here's the Dow. That's today's action. I snapped this a little bit earlier today, so it might have pulled back a bit, but that's a pretty big jump, right? We were so excited to get over 3,600. Now we're up to 36,450. I mean, we're pressing on 36,500 already. But there's another part of this that's really weird. Besides the fact that we're seeing obviously a return to spending that's focused on the real world economy, people going out to restaurants and bars, and we've seen cruise ships bounce back to big 5% gains in some of them today. But there's another element to this, which is paradoxical when you first look at it, and that's what's going on with treasuries. Now, normally when you have strong payrolls report, you would expect to see yields, particularly on the 10-year, go up, because that might indicate that the Fed is considering reining in growth or trying to slow it down. But in fact, here's what happened to the yield on the 10-year Treasury yesterday and today. It just plummeted. I mean, that's a big drop in 2 days. So the question is, what's going on there, and what might that mean as well? So I think what's happening is that on the Fed interest rate side of the market, which obviously influences growth stocks, duration stocks that are going to pay off in the future, the market is already priced in what the Fed has just said what it's just done, which is to start to taper bond purchases as part of QE. But the critical thing is the market doesn't believe that inflation is actually going to be a long-term issue. It might think that there's going to be some interest rate increases in the next couple of years, but it's not a long-term problem. So here's a picture of the yield curve. I've used columns to make it easier to see. But blue is where we were at the beginning of October. Orange is where we are now. Now, the short-term yields haven't really done much. They've fallen a little bit on the shortest term. But compared to the beginning of October, the only yields that have really increased are the 2, 3, 5, and 7. The 10's gone up slightly, but this was actually yesterday's reading that I got from the Treasury website. So it's actually pulled back probably even with where it was at the beginning of October. But look at the 20 and the 30. They've both fallen since then. So how do we interpret this? What does it mean? Well, I think that the market is already priced in what the Fed has just done. But there's another element. I think the bond market is starting to just discount the idea that the Democrats are going to pass any of their economic agenda. And if that happens, basically that means you don't have to worry about, well, they think there's an inflationary danger there. But now they think that goes away because the spending is not going to happen. They think tax increases won't happen. And I think that's what's driving the bond market. So we could see a situation where, in addition to consumer stocks, cyclicals, materials, industrials, energy, all that we also see a recovery in growth stocks. The only problem is that we're going to miss out on some of the investments in essential social infrastructure that these bills promised, which is going to cost us in the long run. But for investors in the short term, let's throw up some confetti.
All right, so let's catch some of that confetti, Clint, and tell me how to play this for the short term.
Yeah, there's a couple picks we have in mind. The first one is what the PEJ is a ticker. It's an Invesco leisure and entertainment ETF. I think this one's more of a thematic ETF. There's not one specific sector or industry that you're getting exposure to. It holds restaurants, hotels, resorts. So it's more thematic toward what you would think of as the reopening play. And with some of the news that we've had this morning, some things we're talking about earlier, we're seeing a big jump in this ETF's underlying holdings that's driving some pretty interesting price action for the overall ETF itself. And so here's a chart to show what I'm talking about. This is the PEJ ETF going back about a year. And a couple of things I want to highlight on here. One is that we've been in this basing period for quite some time now. The well-defined area of resistance that you can see with the trend line that I drew on here. And if you look at just the most recent price action, you can see we'd come down, we tested the 50-day moving average, which is the black line, but then you see us gap higher. In technical jargon, what you would call that right there is a breakaway gap. And breakaway gaps can be very meaningful for future upside here. So just jumping over that resistance level that I'm highlighting, that you can see with the arrow on that breakaway gap. And in addition to that, we've got the can't do a chart without talking about the MACD. It's at the zero line and just starting to turn higher. Same thing with the RSI. In the bull market trend, you tend to find support in the RSI, the green line at the bottom around the 40 level, and we're turning higher off that. So other confirming indicators, confirming that gap higher. I expect to see a lot more upside here in this ETF.
We've got a second one as well, actually, which is XRT. That's basically the classic retail ETF. And here's a chart showing that one. It's been trading in a range, which we've highlighted by the box, really since April. And that's the classic go to the store, buy stuff ETF. And what we're seeing there is, again, we're seeing a gap up. It's a pretty solid breakout. In fact, I think that's the highest price that we've seen this year for that. And it comes after a period where that short-term moving average was starting to get dangerously close to the longer term. So that's a pretty convincing move by the markets, and we see that reflected in RSI as well as MACD. So the big question here, I think, is where we go from here. And one of the things that some people are beginning to talk about is that with all the stuff that's stuck on these ships outside of Los Angeles and Long Beach, eventually they're going to solve this problem. I mean, and they're going to get some throughput, and then all the stuff's going to come flooding onto the market. We could see prices drop, and that could lead to a lot of consumer spending as people realize that the money they've been holding back because they're worried about inflation or whatever, that it's not happening. Boom, they could go out there. So these retail level ETFs and the underlying stocks, they could be very strong this year. You think Target, companies that have that kind of profile.
Thank you so much. I know where you two stand on the issue, but I'd like to hear from our viewers. Do you think we're going to turn a corner? Do you think this prediction will come back and bite us? What do you think? Comment below and make sure you check out the Bauman Letter. Again, we'll see you next week. Thanks so much.